If you worry, you don't have to worry. And if you don't worry, you have to worry.
It was the worst day on Wall Street since the crash of 1987.
I have been a rich man and I have been a poor man, and I choose rich every fucking time.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
We were in a plane flown by pilots who didn't know what's going on.
Well, a sea change is a major transformation of the environment, a complete change in attitudes, etc.
Welcome on board. Take a seat and listen what market thinks. Welcome everyone. To begin with, I would like to give you a quick overview of what you will get here. So let's go through it. At first, the economic overview of the market, current, aggregated, sorted with a reference to major global economies. The second thing will be an analysis of the situation in the major stock and commodity markets, with conclusions and an attempt to create a baseline scenario for a given market. Only facts, news, data, statistics from global economy and financial markets, all independent and divided chapters. If you are interested in a particular market, then you can also go there directly. What else? I think and add new formats in the future on this channel, but be prepared for that. Why and how often? Well, as a trader, I read and analyze a huge amount of new data or news every day. On the other hand, I rarely have the opportunity to see them in a arranged form, so I have to do it by myself. Since I do it anyway, I figure I would share it. I think it will be useful for both someone who is interested in financial markets and the ordinary person who would like to know what is happening in the world at the moment, where we are now, and what developments are likely in the future. How often? I think it will be two times a month. I'm talking about this format. So let's get started. Okay, this is how the US economy starts the new year. Here we have some basics macroeconomics indicators that will help us understand the situation we are in. Let's start with inflation, which is now the biggest actor in all the media. While we are about to have another reading soon, however, the peak of inflation, as you can see, is most likely behind us. Of course, the core inflation and its structure that not yet look perfect, but we will not go into that now. The fact is that the Fed is fighting elevated inflation by two things: rising rates and QT program. What else we've got here? Falling inflation readings are good for both the markets and the US economy. On the other hand, as we look at the next indicators, we see that readings can be good for markets but bad for economy, and vice versa. Why is like that? It's all due to the actions of the Federal Reserve and the QE program started at 2008 and 2009, which totally changed the face of how markets view certain events. The Fed have two powerful instruments: the ability to purchase of assets by expanding its balance sheet, and the second one, the ability to change interest rates. Basically, Fed subjugates all players in the market, because no one wants to kick themselves with a horse. So a new way of looking at macroeconomics data has emerged, where good is bad, bad is good. We had an example of this during the pandemic, where the specter of crisis led the Fed to react quickly and stimulate the economy with an enlarged asset purchase program. For that moment, it worked. But today the situation is somewhat different. It was not the specter of weak data from the economy, but the spreading inflation that changed the monetary policy. That's a big difference. Financial markets were used to a situation where worse data gives a chance for help from the Fed. So, if it's bad, the Federal Reserve will help through an asset purchase package. So if you look at the GDP or the unemployment rate, the markets assume that a significant worse in these indicators and the economy entering a recession will eventually force the central bank to intervene. But not this time. As you can see, the actual 3.7% unemployment rate is in its normal ranges for the US. The markets will start to be interested in this once it starts to rise, and then they will look at how fast this unemployment is rising. In the case of GDP, we already have the first signs of a slowdown. Same as with unemployment, investors will look only on the dynamic of this, because the slowdown is already in prices. Everybody knows will be a slowdown. At the end, we have the interest rate hike cycle, which is nearing its end. We of course estimate one more hike of 0.5 percentage point. The main issue becomes trying to correctly bet on how long interest rates will remain high and when Federal Reserve can change monetary policy. And here we come to the most important thing. What is it all about? In 2023, the most important thing will be how fast inflation will fall in relation to the other economic indicators. Why? Because the Fed will be afraid to make the mistake of the 70s, when central bank changed monetary policy too quickly and let inflation shooting up again. In 70s, we had two spikes of inflation. So if inflation falls slower than expected, while economic data starts to dive, then in my opinion the Fed will not help the markets or the economy. This is the worst possible scenario, but quite likely. If it happens, the rebound in the markets at the end of 2022 can be presented as a last dance on the Titanic. Let's see what are the other risks and opportunities in 2023. Let's move on. Okay, let's analyze 2023 in terms of unknowns, potential risk, and potential catalyst for growth. Let's start with the end of the inverted economy, where for markets bad is good, good is bad. If the QT program and interest rates remain at elevated levels for an extended period, and the economy remains stable, we are likely to return to the pre-2008 economy. Is it good or bad? What you think? It's hard to say. If we don't return to QE, it will certainly means for the markets a slower rebound after a slowdown or a crisis. There will be less money in the market, there will be no artificial demand for bonds, and a number of other factors. To fairly answer this question, I would have to do a separate episode just about this. So let's go further. Next, we have something that is not talked about, the real estate market. Possible turbulence is yet to come. The interest rate hikes and their implication for the real estate market are well known. However, they act with quite a delay. I don't think there will be a repeat of 2008 or 2009 crisis. The structure of the credit market is somewhat different than it was then. But that still doesn't mean that we will go through this smoothly and it will not affect the stock markets. Central bank policy will of course have an impact on the real estate market. The longer the situation continues, the worse it will be for the real estate market. However, it's hard to estimate the scale of the turbulence at this point. Okay, let's check the risks. At the moment, the markets are discounting the current state of war in Ukraine. There is no possibility of a quick end to the conflict, or at least such a scenario is not considered by the markets. On the other hand, the other extreme scenario, I mean the possibility of expanding the conflict to more countries, is also not discounted. The front has frozen. We are in the winter time and both sides are preparing their facilities for possible offensive as soon as the conditions will be right. There is no chance of negotiations that could end in a peace pact. But we have a completely different potential conflict that is being talked about and which will potentially cause huge turbulence. The markets for now see no point in discounting this type of scenario because it's unlikely at this point. Of course, we are talking about armed aggression because the economic conflict has been going on several years between the United States and China. Started by Trump, and the next punches are being delivered by the Biden administration right now. However, at this point, no one is considering an open confrontation over Taiwan in the near future. By the near future, I mean 6 months or a year. The escalation of tensions will have an impact on the markets, but this will be rather short-term catalyst. Of course, unless the situation starts to move evidently in one direction. Let's return to the Fed. Central banks are tightening monetary policy in the most developed economies around the world. Japan is also becoming increasingly hawkish. A bigger threat than rising interest rates may be the quantitative tapering program. We are currently pulling 95 billion a month from the markets, the most ever. Let's look at it this way. We have a luxury home and luxury car, monthly living expenses well, and a budget for entertaining. Now someone is taking money away from our entertainment budget. We are not happy, but it's not the end of the world. On the other hand, no one knows how we will react when they start taking away our car or ask us to move to a smaller apartment. We have started a certain process for the first time ever on such a scale. So far everything looks good, but further the situation will become more complicated. No one, I repeat, no one knows what the consequences this may cause. It's like a Jenga game. We take out blocks, but no one knows when and which block will destroy our building. The last thing. Every crisis has a headline-making hero. He usually appears in the last phase of the crisis. He's like a dry grass fire, spreading very quickly. Who will be the corpse in the closet in the current situation? We don't know, because it falls out of the closet only when the situation already becomes really serious. That, in my opinion, is yet to come. It's not like that there is only a wall in front of us. Let's look at what can save the economy and the markets. Rapid decline in inflation. As I mentioned, the peak of inflation is behind us. Unless there is unexpected turbulence, we can expect further declines. The question is how fast. Note that currently the environment is favorable for inflation to fall. The potential slowdown is causing declines in the oil and gas markets. But we are approaching the limit of profitability of production by some countries. OPEC is talking more and more loudly about possible production cuts to reduce supply and therefore increasing or stabilize prices. I will talk more fully about this in the future episodes. If inflation falls quickly and the economy remains strong, interest rates will not be raised further. This will open the way for the continuation of current monetary policy, including quantitative tapering. However, in the long term, this will cause declines in markets and economic data. Only then will the Fed be able to make a change in their monetary policy. Without a return of inflation to the area of 3%, the Fed's pivot is rather unlikely. The bottom line is that a rapid decline in inflation will give the Federal Reserve more room to move. And as a result, the economy and markets will pass more calmly through this period. Okay, let's summarize what we know and what to expect in the first half of 2023. Inflation will fall through stabilization in fuel markets, rising interest rates, and a high base for further readings. The question is what the readings from macroeconomic indicator will be in the following months. If the economy dives and inflation is high, then we will have a serious problem. If inflation dives to around 3% for the year, then we have the mildest scenario, where the Fed will have room to help if a recession is threatened. The most likely scenario, however, is one where inflation will fall, but not very fast. The decline in inflation will be held back by fluctuating oil prices, gas prices, and a post-pandemic opening of the Chinese economy. The new bull market will be held back by the continued QT program. One thing is certain, it will be an interesting year. Thank you for watching and welcome to future episodes.